Hello and welcome to the latest edition of The Week Ahead, discussing key events to look out for next week in the week commencing Monday the 13th of March. Now I'm Rowena Harris-Doughty and joining me is LCG Senior Market Analyst Jasper Lawler. Jasper, now it's very much a central bank heaven next week with some politics thrown in. So just to quickly touch, we saw a strong report on Friday in terms of US jobs. We saw, 235,000 and a fall in the jobless rate to 4.7%. Now, if we talk about the FOMC meeting that's taking place next Wednesday, traders are already pricing in pretty much 100% a 25 basis point hike by the Fed. What can you tell me about market expectations right now in terms of the pace of Fed hikes this year?
Well, firstly, can I just say, I do feel a bit guilty for gate crashing this week ahead. I promised for 3 weeks that you were going to come back, and here I am in the video again. It's my apologies, everyone.
This is a good thing.
In terms of expectations for the markets, I think the Fed has basically said three rate hikes according to their dot plot. Mm-hmm. Markets have been saying 2, but suddenly, given this rapid expectation change for this particular March hike, now the market's positioning for more like 3. And we've seen massive dollar strength, dollar yen pushing up to the highest in a month. The pound has really been low against the dollar. Obviously, Brexit considerations there as well. The interesting one is that the euro has been up against the dollar in the past few days. So whether the Fed actually go next week, that will be a key one to watch.
Speaking of the euro against the dollar, now we are seeing a sub-parity call for the euro dollar for 2017, but this is where analysts are divided, so I'm interested to get your opinion. The euro dollar had been hovering around the 105, 106 mark for the past month or so. What direction do you see this FX pair going in?
Well, I tend to be on the more positive side towards the euro. Even though we've got a lot of election risk in Europe, I think the way the market's set up at the moment is it's thinking about how the two central banks are diverging in policy at the moment. Obviously, the European Central Bank, we know from the last meeting, still ready and willing to print 60 billion euros per month. The Fed is setting up for a March rate hike, we think, next week. So that's very different. One, raising interest rates, a massively easy policy. But what will determine the euro going forward is whether that difference gets more or less. And I tend to lean on the side that actually it's going to get less. The ECB are going to have eventually react to the higher inflation in Europe, which is now at 2%, so it's meeting their inflation target. In the US, they're very gradually raising rates, and they're aware of all sorts of political risks this year. There's plenty of things, just like last year, that could stop them from hiking as much as they want to, and that would mean that differential between the policies coming in, and to me that would be a positive for the euro.
Of course. Well, still talking about the euro area as a whole, I'm going to brush over the subject of the Dutch elections. I know they are taking place next Tuesday, but we do and will have a bit of a Dutch election special video next week, so we'll talk a little bit more about that in depth, bit of a plug for both of us. I want to touch briefly on UK employment before I talk about the Bank of England. In terms of the figures coming out of the UK at the moment and the general jobs landscape in the UK, what's it looking like at the moment, especially when we talk about the broader picture with everything going on with Brexit?
Well, the general idea is that actually unemployment has remained stubbornly low, even though there were forecasts that Brexit would trigger much businesses to hold back on hiring. Suddenly the unemployment rate would go higher after Brexit. That hasn't happened. Though what has happened in just the last couple of months really is that there does seem to have been a bit of a slowdown in the pace of hiring, and some are seeing that as a sign of things to come, that actually businesses now have taken a bit more time to react to the idea of Brexit. And I should say that actually for both the Bank of England and the unemployment rate, the way the markets react to that is going to be very much coloured by when Theresa May actually decides to trigger Article 50, because that could be even Tuesday next week, depending on whether there's this ping pong where the House of Lords flip back and forth on these amendments with the House of Commons. That could be over quite quickly at the start of the week, and Theresa May just opt to get the whole thing out of the way. There's a lot going on March 15th already with the Dutch election and the Fed rate hike, so I don't know if she's going to add Brexit Article 50 to it, but she could do that on Wednesday or go for it on Tuesday or leave it. So there's that uncertainty of it, how do markets react. That's going to affect how the pound, I think, reacts to those unemployment data and then the Bank of England later.
Just throw a little bit more market volatility into it. Well, in terms of the Bank of England obviously meeting on Thursday, now everyone already expects them to keep rates low for basically the foreseeable future. But it's a tricky one because obviously we've got all this mix of uncertainty with Brexit in terms of the economic outlook for the UK. At the same time, inflation's rising, but at the same time, with all the uncertainty going on with Brexit, it's a catch-22 for the Bank of England, is it not?
Well, exactly, yes. I mean, and they haven't really, for themselves, I think, decided which way to lean on it yet. So that's why I think you're right. I mean, it's going to be pretty much the same interest rate in the UK for the next number of months until they decide, well, inflation's the bigger worry or any potential fallout from Brexit's the bigger worry. The way the market's positioned, the fact that pound is at 7-week lows against the dollar now, obviously partly dollar strength, but I would say largely Brexit related as well, the market's positioning for upset in the early stages of negotiations to be the bigger factor and for the Bank of England to hold off. And probably the Bank of England are aware of the fact that there's European elections and we're closely tied to the European economy as well. So if there is a bit of a populist revolt in Europe, maybe that weighs on the UK economy as well. So that's probably another reason for them to hold back. And if interest rates aren't rising, there's the uncertainty, it's all a bit negative for the pound.
Okay, brilliant, Jasper. Thank you very much.
Cheers, Rowena.
So that's a brief wrap up on the week ahead for next week. Now, what I will say is tune in to Jasper's webinar on Monday for a little bit more of a technical analysis look at where the charts are at the moment, and also in terms of some of the events that we've mentioned, and taking a stronger look at the charting analysis for them. So that's at Monday at 12 p.m. GMT. So make sure you register for that. In the meantime, don't forget to subscribe to our social media channels as well, which are at the bottom of this screen. Have a lovely weekend. Have a lovely trading week. Good luck and goodbye.